What's up, guys? Welcome back to another YouTube video. Today's video is going to be on what is the S&P 500 and why does it matter? If you're into investing or you've heard anything about investing or anything related to investing, you've heard of the word S&P 500. So, what is the S&P 500 and why does it matter? When people talk about investing, there's one thing that comes up over and over again. It's usually the S&P 500. You hear investors mention it, you hear regular people talk about it, you hear financial creators talk about it, you hear someone like me talk about it. Just invest into the S&P 500. That's what people say, right? But what exactly is it and why does it matter so much? In this video, I'm going to be breaking down why it matters and what exactly it is. So, the S&P 500 is a stock market index, and all that it really means is it's the top 500 companies inside of the United States. So these are the top 500 largest publicly traded companies in the United States. So the most notably, the biggest companies that you might know of and hear of that are in this S&P 500 are Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta. These are your top 7 companies, your Mag 7 like they always call them. All right, so when people say, okay, the market is up today, they're usually referring to this S&P 500. The S&P 500 is an index that tracks all of these top 500 companies and puts them into one, right? It kind of gives the company, the totality of the companies a grade, right? In a way, it tracks them, right? So whenever you'll see, let's say you check on the website or Google and you see that S&P 500 and you search it up and then you see we're up 700 or something, right? Or you just see a long number like 7,456. That's kind of like a grading system for the top 500 companies in the world. So just think about it like it's a scoreboard for the economy and the stock market. So if many of the companies inside the S&P 500 are growing and they're making money, the index is rising over time. So if these companies are also struggling as well, the index usually falls. So this is why you see the S&P 500 doesn't always go up exactly, but it goes down sometimes. So why does it matter? Why is it important? The reason the S&P 500 is important so much and it matters is because it represents a large part of the US economy, right? I told you the top 500 companies inside of the United States, the top 500 largest traded companies in the United States. So these companies impact technology, healthcare, finance, retail, communications, energy, and a whole lot of other industries, right? Millions of people use these products from these companies every single day. So you use Amazon, you buy packages, you use Google, you buy new iPhones that come out, you use Tesla if you have a Tesla that you bought, you use Microsoft if you're using a regular computer that Microsoft created, you're a customer of Microsoft. So when the S&P 500 grows over time, it often reflects the growth of major businesses and the economy as a whole. But there's another reason why the S&P 500 is important. The S&P 500 has performed very well over the long term. Even though the market goes through crashes and recessions are basically times where the market just goes down, right? The market goes down because people are spending less. Companies are not making the same amount of money that they were making before. And we go in a crash. People are not investing into stocks because they feel like they need to hoard their money. They feel like they need to hold on to their money. So if this happens, this is what usually leads to a recession, right? If stuff like eggs, milk get too pricey, people feel like they shouldn't be spending and they feel like they should be saving more. So this can lead to a crash in the economy. So even though we have these volatility, we have these times in the market where it's crashing, where we're having recessions, but over decades, it has consistently trended upward. So the stock market is consistently moving upward no matter what, right? You might see in one year we have a down year in the S&P 500, but that next year we're making new all-time highs, right? Because companies start coming out with more products, companies start marketing more, or companies start doing more to grow revenue. And if you know anything about these companies and these CEOs, they're going to do everything that's in their power to continuously make more and more money, because that's what gets them that's what makes their company more valuable. And the more valuable these companies are, the more it's better in the eyes of an investor, someone like me and you, to invest in these companies. So this is why long-term investors pay so much attention to the S&P 500. So if you want to ask this question about how you could potentially invest into the S&P 500, you can't directly buy the S&P 500 itself, but investors, like people like me and you use index funds. You use ETFs to buy the S&P 500. These index funds, these ETFs track the S&P 500. So these funds are designed to basically mirror the performance of this index. When I say index, the S&P 500 index. So when the S&P 500 goes up, the fund goes up with it. Some popular examples of ETFs that you might have heard of is SPY or VOO, right? Or IVV. And one reason that these investments are so popular is because they diversify. They have, like I told you, they have multiple different companies from different sectors, from different industries. So it's not only tech companies, it's not only financial companies, it's not only retail companies, but it's a broad variety. So if one industry is down, another industry is holding the index up. If two industries are down, the rest of the other industries are holding the index up. So you get a spread out diversification way of investing into the market. So instead of putting all your money into just one company, through these ETFs, you get to put your money in a little bit of everything. A little bit in Apple, a little bit in Meta, a little bit in Tesla, a little bit in Walmart, right? You get a broad variety of different companies that you're investing through via these ETFs, via VOO, via IVV. So this usually reduces the risk compared to just relying on a single stock. You might hear sometimes people talk about they invested in this stock, they lost money, right? ETFs are here to kind of negate that, to kind of block that. It's kind of like a, what's the word? It's a, if you were thinking, if you were thinking of the opposite of a stock and where you could just do it safely and have multiple stocks, this is what an ETF is for. It's a basket of stocks into one fund so that you can invest your money into multiple different companies. Why long-term investors love this strategy, why they love investing into these ETFs, why they love investing into the S&P 500. A lot of beginner investors think investing is just about finding the next good stock, finding that next good stock that you can buy to make big amounts of returns. And while some people do make money that way, but majority of people don't make money that way because you can't time the market. You, as a regular investor who's just starting, you don't necessarily know too much about stocks. You don't know exactly why you're choosing a stock. You might just be going off sometimes what you hear on TikTok, or if you watch the video of a guy telling you to buy this stock, right? This is why people go the ETF way, because you're able to consistently just be investing into an ETF over time without having to go look at a stock, go look at the company, go look at its financials to see if it's uh, making good revenue, if it's making the amount of money that's it's supposed to make, if its earnings per share is right, if the stock is performing well. You don't have to do all the heavy lifting. ETFs are more broad in the aspect that they have more companies inside of them, so you can just have your money diversified into different companies. And over time, if you're consistent and you're investing into the S&P 500 over time, through market crashes, through recessions, through bad economy, through good economy, and everything in between, your portfolio will likely grow over time. And this is where compound growth plays a factor. This is where compound growth plays a factor. So compound growth is when your returns that you make in a year compound over the next year, right? And those returns compound over the next year. Those returns compound over that fourth year. So this is usually what happens when you have compound growth that helps your investments and it boosts your investments. It's not really the investments that you're putting into. Yes, the investments that you're putting into grow your account. But as time goes on, as you get to year 20, 25, 30 of investing, it's really your gains from compound growth that are really carrying your portfolio now, that's allowing it to grow. So your investments start to grow because your gains are now generating more gains, if that makes sense, right? Your returns are now generating even more returns. And over long periods of time, the snowball effect becomes massive. So you have to understand these things. This doesn't mean that the S&P 500 goes up every single day. That's not what it means, right? Do not get that misconstrued. The market can drop hard sometimes. If we're going through a recession, like I said, if we're going through a downtime where like people feel like they need to save money, they're not going to spend, companies are not reporting their revenues the same, right? Revenues are dropping and companies are not making the same amount of money they were making before. The S&P 500 could go down, right? But for the most part, if you consistently invest day in, day out, week by week, month by month into the S&P 500, and you let this continuously grow over time, you're going to see the growth. You're going to see your account growing steadily. Don't look at the short term. Do not be someone who's thinking in the short term, but allow yourself to think more long term, right? When I say long term, 2 years, 3 years, 4 years, 5 years. Majority of the time, the reason we don't allow ourselves to grow, uh we place so much it's like we're rushing to get to where we're at, which I have an issue with that as well, right? You rushing to get where you want to be right now, instead of allowing yourself to grow over time and playing the long game. The long game is always better than the short game, because then you're able to, especially in investing, you're able to see your investments, your portfolio grow over time. So I hope that I gave a good rundown of what the S&P 500 is. Top 500 companies inside of the United States, right? And you're able to invest into them via ETFs like SPY, VOO. VOO is the main one that I would suggest. Over time, you consistently dollar cost averaging. Dollar cost averaging is just investing no matter what price is. Don't try and time the market. Don't try and see if you can buy during a dip. Don't don't do none of that, right? Because the more and more, I'm pretty sure there's some research on this, but the more and more you don't invest and try and time the market, the more you're gonna miss out on earnings, potential earnings that you missed out on because you were not investing and you were not dollar cost averaging. So please, please, please go do some research, go watch more videos on the S&P 500. I hope I gave a good overview about what it is. So go check it out. And do not forget to like, comment, and subscribe down below, and check out the rest of my videos, and check out my website eawealthteam.com. I have a budget tracker on there. I have a network tracker on there. I have one-on-one consulting if you need it, and I also have a Roth IRA blueprint guide, which allows you to open a Roth IRA and start investing into your Roth IRA the right way. So thank you for watching this video. I think the website, I don't know if I said it, it's called eawealthteam.com. Thank you for watching this video, and hope you guys have a good one. Peace.